Hey, Dan.
Good to talk to you again. You've had a busy day, haven't you?
Yeah, one call after another and trying to do research in between.
Yeah, I think I've been on a couple of the webinars or live town halls, whatever you want to call them, this morning. So I think I've heard you speak a couple times. But why don't we start the conversation with kind of that the same thing you've been talking about all day for our members, and then we do have a couple of questions from our members that they've sent in. So why don't we start with you?
Yeah, sure. So obviously the economy right now is suffering from a large degree of uncertainty. What makes the current environment challenging is that uncertainty is not coming from a financial or economic shock, but obviously from a biological shock. What we're estimating right now in our benchmark forecast outlook is a 6 to 8 week mitigation effort. We don't think this is going to be over by Easter, although certainly we can hope that will be the case. So we're basically assuming at this point that we're going to see a flat or even a slight decline for GDP growth in the first quarter. It's the second quarter that's going to be ugly, and there's really kind of no way of describing around that term. We're expecting about an 11 or 12% quarterly decline in GDP growth in the second quarter. We think that the third quarter will also be negative. I'm sure people have seen other estimates. There's one from Goldman Sachs that says that the second quarter number could be a decline of 24% GDP growth rate. I don't think it'll be quite that large, but on the other hand, the Goldman Sachs team also has the third quarter with positive growth. They think this is going to be very sharp and very short. I don't think it's going to be as bad in the second quarter, but I don't think we're going to be in a rebound mode for the economy until the fourth quarter. But overall, we do think we're going to have a rebounding economy. That prior public health emergencies suggest that these things eventually do end. There's some data that suggests it may be seasonal, which in case, if that's true, it's kind of good news in the short run, and it could be some bad news in the long run. The good news is that maybe we'll get a bit of a break come the late spring and summer. The bad news is that we may have to deal with it again in the fall and the winter, which makes getting a vaccine that much more important. For housing markets right now, we're estimating that single-family construction this year, under a 6 to 8 week mitigation effort, would be down about 7%. That's actually one of the better performing sectors. Apartment construction probably will fare a little worse, down more than 10%. Remodeling, depending on whether or not residential construction is deemed an essential business in local markets, remodeling may do a little bit better in the long run as state and local governments make exceptions for repair activities and the like. But overall, we do think home building is going to be down this year. I think what we can just basically hope for at this point right now is the social distancing exercises that are underway are successful, that they suppress the levels of the virus in the same way that we've seen in, for example, South Korea, where it's not eliminated, but it's reduced down enough that the economy can get back to work. So there's going to be some permanent changes ahead, but we think by the time we get to the fourth quarter, we'll be in a rebound mode.
That sounds really good to all of us here. I think to get to the rebound sooner than later. We talk a lot about Des Moines, and it's not unique in this regard, but Des Moines is very white collar in nature. Do you see markets that are typically more based in white collar industries rather than manufacturing or blue collar industries would tend to have a quicker recovery, or do you see a nominal difference between them?
Yeah, so I mean, at a very high level, before we get to the regional, obviously markets that are more dependent on what we think of as social-based service sector are going to have the most amount of economic damage in the short run. So those are markets like Las Vegas, like Florida, that are kind of heavily based on tourism and transportation. If your local market is dependent on cruise ships, things are going to be bleak here for the next few months.
Right.
If it's more agriculture, manufacturing, like you said, white collar, that can be based on more online interaction or people doing that kind of work, the market can adjust. The restaurant industry is still going to be a challenge. But I think right now, the data that we're seeing, the outbreaks seem to be concentrated in the Northeast and the Northwest. Again, a little hint of some seasonality to that, but they're kind of in the same temperature band that, say, Italy and South Korea, parts of Japan, Wuhan itself in China are in. So as temperatures warm, that would suggest that outbreaks will tend to move farther north, and areas in the south will still be exposed because no one's been exposed to this before, but the rate of transmission might be a little bit lower. So, I think more white-collar type environments are going to be a little more robust to this, as are areas as temperatures warm and humidity rises.
So it may not be aligned with the temperature zone or the climate zone that it's in, but we definitely see, or it looks as if at this point, the upper Midwest, relative to the coast, the number of positive tests and people that have this. Do you think that there'll be a correlation historically? We don't have a lot of data, but we've been through other recoveries in the past where certainly areas of the country have been hit harder. Do we ever see a correlation with those, or is that just purely not something that we even consider?
Yeah, it's funny. So we've spent the last 4 or 5 years listening to people talk about the proponents of density. Myself, I've been kind of in favor of townhouse medium density type development as a supplement to existing single family construction. I think your question is getting to a point which is putting aside the temperature or humidity element. What we're definitely seeing is areas with population density, large mass transit systems. Those are the areas where this can spread the fastest. So areas that are a little less population dense, that are kind of more dependent on cars and single-family homes where things are spread out a little bit, those seem to be more robust to exposure. So I don't think it's a surprise that New York City right now is really kind of bearing the brunt of this, because that's where you've got the most highest density. And, if you've ever spent time in New York, you know that you've got to get in a cab or you've got to get in a subway, and you're going to interact with thousands of people going just a few miles. So New York is unfortunately going to be the test case for some of this in terms of how social distancing works, and also on the temperature side. We simply do not know if it's seasonal. Other similar viruses appear to be, certainly the flu is, other forms of coronavirus. I think the hope would be that it is, because then that will give us time to ramp up our medical infrastructure. Because there's one thing, and now we're sort of exiting biology and entering economics, we can't shut down the entire U.S. economy for quarter after quarter after quarter. So any kind of social distancing is really going to be a pause to give this opportunity to deploy science and deploy capital to fight this. That's unfortunately the only way out.
Right. Well, it's certainly hopeful that if that is the case, that the fourth quarter projections come true, because that'd be about the time that seasonality would be kicking back in. So hopefully, if that is true, then we've got medicines, vaccines that we can go out and we can start immunizing people ahead of time if they weren't exposed. So great. You did hit on the market or talked about recovery a little bit. I know everything is just speculation in its gut, and this information may be outdated the minute that we hang up based on information that we get. But do we have any benchmarks from previous I don't want to say recessions because I don't know that it's officially been called that, but previous downturns that we've had that we can use for the recovery? I know the president seems confident. I know the projections talk about the U curve and V curve. Do we have anything data-wise from history that can help us see that in the past we've made a recovery in this amount of time, and this gives us more hope, or is it just a gut?
At this point, it's got educated guess. What we do know is that when we came into 2020, the economy was in pretty solid shape, and the housing market was continuing its improvement. It's been a slow improvement, but the housing market was actually beginning to approach strong levels of performance. Multifamily, single-family construction was still not where it needed to be, but it certainly was expanding. The most recent home price data showed 5% price gains year over year, so the demographic demand is there. I think really in the short run, it's about bridging from March until the fall to make sure that households can stay whole, that small businesses can stay open and operation, that the banking system gives space and opportunity for people to pause on loans as required. If we can pull that off, and certainly that the federal government with a $2 trillion stimulus package that includes direct grants to households, that offers additional business lending, and then with the Federal Reserve, the nation's central bank, basically underwriting all of this using quantitative easing, and they're going to add trillions of dollars to their balance sheet. The tools are there. The political will appears to be there. So it's really just a question of whether in the short run then those mitigation efforts are successful.
So you hit on two things I guess I'd like you to expand on or get your input on. One of the questions from our members was some data would indicate that home values don't always depreciate during a recession. Do you agree with that concept? And then you mentioned the stimulus package. And tell me what you think about the stimulus package.
Yes, on home values, the issue here is, well, in the short run, we're not going to see price declines because the housing demand is really strong, and really what we're going to see is actually a lack of inventory, a lack of opportunity. So in a sense, the housing market is going to hit pause. Now, here's the kind of the wild card of that. It really depends on what the unemployment rate is going to do over the next quarter. In our benchmark model, we've got it rising to 7%. But that could easily be 10% depending on the number of job losses. Just to put things in perspective, nationwide, 15 million people work in the restaurant industry. Now, some restaurants have moved to a kind of a takeout only mode, so it's not like every single restaurant is shut down. But certainly, the restaurant industry by itself is going to be shedding millions of jobs. It has, and it will continue to do so. So when you get that level of unemployment, then the demand for home sales will weaken. So, the demand for housing and the prospect for home prices is really then dependent on, is it more U-shaped or is it more V-shaped? I think it's going to be something in between. So in our model, we have a slackening of home price growth that comes about because both you have restricted supply. Like I said before, we do think single-family construction is going to weaken somewhat. And then you also have weakened demand, and those two things then are offsetting each other. I believe in the most recent forecast model that we've done, we think home price growth will basically slow to a 0% pause in mid-2020. And I think that's where we're going to go. On the stimulus bill, it's a $2.2 trillion bill. Economic income in the United States is about $900 billion per month. So basically, we're talking about a bill that fills about a 2-month hole. So it's called Coronavirus 3, I believe. It's the third kind of major action taken by Congress. The fourth bill they're going to start working on it now.
Wow.
Because they need to be thinking about, the numbers are staggering. When you think about the stimulus bill associated with the Great Recession, remember, it was below $1 trillion. This is a $2.2 trillion bill. Again, this is not being produced by a financial crisis. We know that, right? It is simply just a sudden stop to the economy. And the analogy that I've been using is it's like we've decided to, kind of take the advice of the public health officials and put the economy into a medically induced coma in order to buy time for the medical infrastructure to get up to speed. And so, a $2.2 trillion bill basically buys us 2 months. So they're going to have to start working on the additional problems. I think, keeping small businesses whole and in operation and ready to hire back those workers to get from now until whenever we get kind of stability in the case counts. That's the mission of the next bill. So the $2.2 trillion is really just kind of, right now what's needed, and then they're going to need to be thinking about what's needed to get us through the rest of 2020 in the next piece of legislation.
So historically, it's unbelievable, and our debt is at an all-time high. Is there a point where we can't do it anymore? Is that an option for the government at this point, or is it still just keep printing money, hoping for the best?
Well, so usually the cost of having a large federal deficit is inflation. And inflation has two impacts. It erodes the value of wealth, and so it's actually basically a stealth tax on wealth. Means your money can buy less, and it increases nominal interest rates. And by increasing nominal interest rates, it then slows investment. Typically when you think about a large federal deficit, it's not being financed by the Federal Reserve. So that's a slightly different case because they're going out and they're saying, okay, the Treasury issues bonds, the Federal Reserve buys them, it puts it on a balance sheet, but it puts those bonds basically in, kind of a special account, and that does not circulate. Now, that doesn't mean in the long run it's not inflationary, but in the short run it's not. Is there a limit? Yes. You cannot, for example, put the economy on pause with maybe 40% in non-operation, flood money into the household sector, and not expect prices to go up as a way of rationing. Just producing additional money is not going to make up for the fact that the output itself is not occurring. But in the short run, it can act that way for households to make sure that they can pay the rent and you don't get a financial system collapse, which can domino onto itself. So, look, we've got to get to a point by the summer where we've either said, okay, the mitigation efforts work, and other countries, it looks like it takes about 2 months. If it does not work here because maybe we started too late, then we need to find what our way of life is going to be. And look, the way the United States beats things, whether it's World War II or anything else, is science and capital. And those are the things that are going to be necessary for the U.S. to beat this virus.
That's interesting. I've been telling our members for sure that the way that we operate will change. There's no doubt about it. Some of them will be positive, some will be negative, but we will never fully go back to doing business the way we were. So how do we affect that in a way that it benefits us? So I've got 2 questions for you. I know you're busy, and I'm going to give them both to you so you can finish up on a high note. The first one is, over the short term, 2 weeks, couple months, what concerns you the most that would send us or continue to send us in this spiraling downward trend? And then the last one is, since most of this has been negatively focused, let's end on a high note. So what makes you most optimistic about the short term that would help us react in a positive way?
Yeah, on the negative side, quite honestly, it's hospitals being overwhelmed. Let's watch what happens in New York City. The thing that makes this particular virus nasty compared to seasonal flu or even a tremendously bad seasonal flu is the degree of severe cases who require IV or oxygen type treatment. So breathing machines are basically the limiting factor. New York will offer the test case for that, and social distancing that's been implemented, I believe, will reduce the case counts. We're just we're on the exponential growth curve right now. And one of the things I've pointed out in the last few days is that virus-type expansion doesn't grow unchecked exponentially. It enters something called an S-curve or a logistic where it begins to trail off at a certain point. So looking at other countries' experiences, it looks like 2 months is sort of the key time frame. So I can't guarantee it, but I feel like we're going to have a good control over this in about 2 months. In the long run, things that look positive about, well, one, I do think the country is taking it seriously. I do think the country is pulling together. The Federal Reserve is all in terms of supporting the financial system, so liquidity looks good. The unanimous vote in the Senate on the stimulus bill is a good sign of unity, so certainly everybody's kind of pulling together and moving in the right direction. There's debates time to time. And then, in the long run, we can think about maybe even some of the unexpected consequences of having people stay in their homes for a longer period of time. One of the things in demography we've been waiting for is a baby boom. We've been waiting for a baby boomlet among millennials, and maybe if people are staying home a lot longer, that might just happen.
That's interesting. Well, Rob, we certainly appreciate your time. We know that you're extraordinarily busy right now, and we're also on your calendar, I believe, for this fall. So we're hopeful that we get through the point where we kind of get back to a level of normal, where you can join us here this fall. But we thank you very much for your time today, and we look forward to talking to you again.
Great. Thank you, Dan.
Thanks, Rob. Bye.